Welcome to our discussion on the history of interest rates. In this video, we will trace the origins of interest rates and explore how they have changed over time. We will also look at some key historical interest rate milestones and their impact on the economy. Interest rates have been around for thousands of years. In ancient Mesopotamia, loans were often made in the form of grain, with interest paid in the form of additional grain. In ancient Greece and Rome, money lenders charged interest on loans made in the form of coins. These early forms of interest were often tied to the productivity of the borrower, with the interest rate determined by the likelihood that the loan would be repaid. During the Middle Ages, the Catholic Church condemned the charging of interest on loans, known as usury. This led to the development of alternative lending practices, such as pawnbroking and the charging of fees for the use of money. The charging of interest was seen as a sin, and money lenders were often ostracized and punished by the church. During the Renaissance, the charging of interest on loans began to be accepted once again. This was in part due to the growth of commerce and the need for credit to finance trade and expansion. The development of double-entry bookkeeping and other financial innovations also made it easier to track and manage loans and interest payments. This led to the growth of banking and the development of new financial instruments, such as bonds and insurance. During the Industrial Revolution, interest rates began to be determined by market forces. Banks and other financial institutions began to offer different rates on loans and savings, depending on the level of risk. The growth of the stock market and the development of the bond market also gave rise to new ways to earn interest on investments. The Bank of England was established in 1694, and it played a key role in setting interest rates and managing the money supply. In the 20th century, central banks such as the Federal Reserve in the United States and the Bank of England played an increasingly important role in setting interest rates. They used interest rates as a tool to manage inflation and stimulate economic growth, and they began to engage in more sophisticated monetary policy techniques. The Great Depression and the subsequent rise of Keynesian economics also led to a greater focus on using interest rates to stabilize the economy. Some key interest rate milestones from the 20th century include the Federal Reserve's decision to raise rates in the 1920s, which helped to trigger the Great Depression, and the sharp interest rate cuts in the early 1980s, which helped to combat stagflation and kick off a period of economic growth. In the 21st century, the global economy has become more interconnected, and interest rates have become more intertwined. Central banks continue to use interest rates as a tool to achieve their economic goals, and global economic events can have a major impact on interest rates. In recent years, the use of unconventional monetary policies, such as quantitative easing, has also become more common. Some key interest rate milestones from the 21st century include the Federal Reserve's decision to cut rates to near zero during the global financial crisis, and the European Central Bank's introduction of negative interest rates in an effort to stimulate the economy. Now let's take a closer look at some of the interest rate percentages throughout history. In the United States, the Federal Reserve has set the federal funds rate, which is the interest rate at which banks lend to each other overnight, at various levels over the years. In the early 1900s, the federal funds rate was typically around 3 to 4. In the 1950s, it reached a peak of over 6%, before falling to a low of around 1% in the 1960s and 1970s. In the 1980s and 1990s, the federal funds rate rose again, reaching a peak of over 9% in the early 1980s, before falling back to around 1% again in the early 2000s. In response to the global financial crisis, the federal funds rate was cut to near zero in 2008, and it has remained at historically low levels since then. The level of interest rates can have a major impact on the economy. When interest rates are low, it can encourage borrowing and investment, which can stimulate economic growth. However, low interest rates can also lead to higher inflation, as more money is in circulation. On the other hand, high interest rates can slow economic growth as borrowing becomes more expensive and consumers are less likely to spend. High interest rates can also help to control inflation as it becomes more expensive to borrow money and there is less money in circulation. Central banks play a key role in setting and adjusting interest rates. They use interest rates as a tool to achieve their economic goals, such as low unemployment and low inflation. Central banks can raise or lower interest rates based on economic indicators, such as GDP growth and inflation, and they can also use other monetary policy tools, such as quantitative easing, to influence interest rates. The future of interest rates is uncertain, and it will depend on a variety of factors, such as global economic conditions and the actions of central banks. Some experts predict that interest rates will remain low for the foreseeable future, while others believe that they will eventually rise again as the economy recovers. Whatever the future holds, interest rates will continue to be a crucial part of the global financial system, with their level and direction having a major impact on the economy. It is important for individuals and businesses to understand interest rates and how they can impact their finances. For example, if you are considering taking out a loan, the interest rate will determine how much you will pay in interest over the life of the loan. If you are saving money, the interest rate will determine how much interest you earn on your savings. Understanding interest rates can also help you make informed investment decisions, such as choosing between different types of investments that offer different levels of interest. In conclusion, the history of interest rates is a long and complex one, with the charging of interest having its roots in ancient civilizations. Over time, interest rates have been used as a tool to manage the economy, with central banks playing a key role in setting and adjusting rates. Despite the many changes and developments over the years, interest rates continue to be a crucial part of the global financial system, impacting everything from borrowing and saving to the stock market and inflation. Understanding interest rates and their impact on the economy is important for individuals and businesses, and the future of interest rates will continue to be a topic of interest for many. Thank you for watching our video on the history of interest rates. Thanks for watching. If you enjoyed this video, please hit the like button and consider subscribing to our channel. If you have any suggestions or comments, please feel free to leave a comment below. Welcome to our discussion on the history of interest rates. In this video, we will trace the origins of interest rates and explore how they have changed over time.